Hi, I'm Damion, and today I'm going to answer the question of how will rising inflation affect the Oxfordshire and UK property market this year. So the UK is currently experiencing its highest inflation rate since the early 90s, and this increased price is primarily come about by the combination of an increase in demand for goods and services from consumers following lockdown last year, together with global supply chain disruptions. And most economists weren't too concerned about this increase in the inflation, as they were very similar to things that happened in the 90s following the credit crunch, with a similar rise in demand and supply chain issues. But thankfully, back in the early 90s, inflation returned to lower levels pretty quickly. However, the situation at the moment in Eastern Europe could have changed matters. So what I want to do is I want to look into the factors and what it means for the Oxfordshire property market this year. So the crisis in Eastern Europe has sparked even further rises in crude oil, which obviously diesel and petrol are made from, gas and grain prices, as pressure on supply chains around the world, it increases. So in my previous articles, unknown to what was happening now in Eastern Europe, I suggested UK inflation would rise to 7% in the spring, drop back to 5% in the autumn, and then as we enter next year, be approximately 3 to 4%. Yet with these massive issues, inflation could rise to 8 to 9% by the late spring and still be around 6 to 7 in autumn, well above the Bank of England's target of 2%. So also with Oxfordshire wages rising at only 3 to 4% and inflation at 7% plus, Oxfordshire household incomes in real terms, they're going to fall. This is because real UK household incomes characteristically have been the most consistent lead indicator of growth or a drop in house prices. This is because growing inflation erodes the value of money you earn, which reduces its buying power. When the cash in your pocket has a lower spending power, people tend to spend less when they buy and rent and more on a home and vice versa. So next month, income tax thresholds will be frozen and national insurance contributions are increasing. Collectively, all of these issues will create a drop of around 2 to 2.5% in the real disposable income of Britain's households this year. So real disposable income is somebody's take-home wages after tax, and then the effects of inflation, they're considered. So will Oxfordshire people be more anxious to spend their money? So obviously with less money in people's pockets, people's inclination to spend their money, they do have, it could be curtailed because people's savings are at an all-time high, yet many will decide to sit on their cash instead of just blowing it and spending it, especially as consumer confidence has dropped to minus 26 on the GfK index. All I can say at this point is there is going to be, in my opinion, a house price crash. And it's all doom and gloom. Or is it? So I always like to look at the best of both worlds. And my heart, obviously, it goes out to the people caught up in this awful, awful humanitarian crisis in Eastern Europe. Yet I respectfully need to put that to one side just for a moment for the purpose of my article. So this blog and all my videos and articles are about the Oxfordshire property market, and Oxfordshire people want to know what's actually going to happen to the property market here. So in the first half of the article, I looked at the impending fail and the fall in real disposable incomes of 2% to 2.5% this year. And I appreciate it's going to be very tough for many families here in Oxford. Yet it's always important to consider what has happened in previous times. So in 1982, there was a drop of 2.3% in real disposable income. In 1992, 3.7%. In 2008, 5.8%. Yet it's going to be tough, yet we got through 1982, 1992 and 2008. And so we shall for this year and next year. Next, and you've probably noticed right now, I have the price of petrol is very, very high compared to what it was 10 to 12 months ago. The average price of unleaded petrol is £1.51 a litre today, quite a jump from £1.21 a year ago. But here's an interesting fact. Petrol was a lot more expensive in real terms in 2011 than today. In today's money, a litre of unleaded petrol in 2011 will be the equivalent of £1.79. We have some way to go before we get to those levels, and again, the Oxfordshire economy and property market kicked up pretty nicely after that in 2011. So what are Oxfordshire people spending on their rent and mortgages? Well, housing costs, the owner-occupiers were spending on average 17.3% of their household income on mortgages in 2015. Yet in 2021, this had risen to 17.7%. Not a huge increase, but an increase. Council house tenants have seen a drop in their rent from 29% to 26%, whilst private tenants from 36% down to 31%. And it's pretty interesting that private tenants are proportionately 14% better off in 2021 than they were in 2015. So how we spend our money. The average UK home spent 4% of their household income on energy in 2021, and that's due to a rise of 6% after April. Yet, as a country, we spend 9% of our income on restaurants and hotels and 8% on recreation and culture. As with all aspects of life, it will mean choices, and maybe we'll have to forego some of our luxuries. And just before I move on from this aspect of the article, again, I appreciate I'm talking in averages. Many people with low income suffer from fuel poverty, and they will find increases in energy prices hard. And my thoughts, obviously, they don't go out to you. It affects me, it affects everybody's family. Interest rates. Higher inflation is generally brought under control using higher interest rates, meaning mortgage payments, they're going to be higher. First, 79% of homeowners with a mortgage are at a fixed rate, so any rise won't be instantaneous, yet there will be a bizarre side effect from the issues in Eastern Europe. Surprisingly though, the current situation there, in its very nature, will bring greater UK inflation. It will also probably defer the Bank of England raising interest rates. This means mortgage rates won't increase as much as the bank won't want to, and they won't want to exuberate any pressures to the UK economy next year or the year after, because it's going to cause conflict. The stock market had a price and interest rate rise by 2% at the end of this year, and I suspect this will be no more than 1% to 1.25% by next year, slowly going up in quarters of 1% every few months. The crisis in Eastern Europe might even come as like a defense for higher inflation throughout 2022, all meaning everyone's mortgage may actually be less. Next, I want to look at consumer confidence indexes. These indexes are a very fickle thing, and I prefer to look at the Organisation for Economic Cooperation, which has a larger sample range and a longer time frame to compare against. So looking at the data from the mid-1970s, the drop in consumer confidence is big, yet nothing like the drop seen in the oil crisis of the 70s and the recession of the early 80s and the ERM crisis of 1992 and the global financial crisis 2008-2009. Also, when compared to the other main economics of the world, like the G7, the UK has always bounced back much more quickly from the recessions when it comes to consumer confidence. So what about house prices here in Oxfordshire this year and next year? Well, increasing energy prices, rising inflation and increase of sanctions and a probable drop in consumer confidence and spending in the aftermath of the conflict will knock the post-pandemic recovery globally, which will lead to a recession around the world, including the UK. A recession is basically when a country's GDP drops in 2 consecutive quarters. For the last 300 years, there's been a direct link between the British house prices and GDP. But let me look at what would happen if Oxfordshire house prices drop by the same extent they did in the global financial crisis of 2008-2009. So house prices in Oxfordshire dropped by 16.9% in the global financial crisis. This was the biggest drop in house prices over 16 months ever recorded in the UK. The average value of a property in Oxfordshire today is £446,411, meaning if Oxfordshire house prices dropped by the same percentage in the next 16 months, the average home locally would be worth only £370,000. On the face of it, it's not good. Until you realise that it would only take us back to Oxfordshire prices that were being achieved back in 2015. Yet that will mean if they do drop in price, the 9.6% of Oxfordshire homeowners who have moved home since 2015 would lose out if they sold their home after the price crash. But how many people move home after only being in the home for maybe 5 or 6 years? It's not that many. It's more 10 to 15 years. The simple fact is that 90.4% of Oxfordshire homeowners will actually be better off when they move if house prices crash. And all of this obviously assumes that there will be a crash. The simple fact is the circumstances of 2009 that caused the property crash are entirely different to 2022. No lending by the banks, higher interest rates, and increasing unemployment compared to today's increased lending, ultra low interest rates, and low unemployment environment. I do believe with all that's happening in the world, we might see a rebalancing of the Oxfordshire property market later this year, 2022. And it could see the odd month with little negative growth in house prices, yet it's going to be absolutely nothing like 2009. The expected fall in household spending could be counterbalanced by UK businesses' plans to invest more in their businesses with last year's tax breaks on investing, and that will create even more jobs. So who knows what the future holds? These are obviously just my thoughts with watching what's happening in the world. Hope this is helpful. Any questions? I'm always here. This is Damion. Thank you very much.